Asia-Pacific stocks regaining their footing after sweeping sell-off in global markets. The Nikkei 225 bouncing back from its worst days since 1987, now up more than 8% there. The Kospi, meantime, more than 4% in the green. That's after a record 9% decline. Australia is underwater slightly. That's as investors await the Reserve Bank of Australia's monetary policy decision that's due later today. And U.S. futures also pointing to a rebound following the Monday meltdown. The Nasdaq 100 up by more than 1%. And Sam Chandan, a professor at NYU Stern Finance Department Director at the Stern Center for Real Estate Finance, joins us for more. Now, Sam, it's good to have you on. Let's talk the reaction that we're seeing in Asian markets, of course, this morning, rebounding after that punishing session yesterday. Help us understand what is fueling the buying, and is this a dead cat bounce?
I think that what we're seeing is a period of significantly elevated volatility. And so while we had a record sell-off in the previous session, we're clawing back some of those losses today. I fully expect that over the course of the next couple of weeks, at a minimum, we're likely to see a lot of bouncing around. So again, sort of, in the United States, our VIX measure of volatility has spiked. Given the degree of uncertainty in the market, that is likely to remain the case for some time.
Yeah, and let's take a look at what is causing, all the uncertainty that led to that bloodbath. I think, did it really all have to do with the weak U.S. economic data? Because prior to that, we really saw some unwinding among the mega cap names.
Yeah, I think there's a couple of things going on. Certainly, there's some profit taking off of the extraordinary gains that we've seen, in those largest stocks over the course of the last 6 months, over the course of the last year. Some sense that there may be some opportunity for profit taking here. Combine that in the near term with a couple of different things. One, a heightened degree of risk aversion, given some of the geopolitical developments we've seen over the last week. Some issues related to the carry trade and the increase in interest rates in Japan, that impacting the U.S. market. As far as the economic data is concerned, what I'd encourage people to think about is that the data today is not that different from what the data showed, a week ago, 2 weeks ago, 3 weeks ago. We've seen the labor market in the United States slowing. And that has, again, sort of been the case for some time now. The fact that the most recent jobs report came in weaker than expected. It was a weak report, but not a terrible report. Again, I think is signals that investors have grown concerned about a broader range of factors. The news about the labor market is not new. There's been some reference to the SOM rule, which shows that, and quite accurately, it's been sort of a very effective tool in understanding sort of where we are in the business cycle, in pointing to the beginnings of recession. Some people have shown that what the data shows today is that we are at a point where the SOM rule would tell us that we're early in a recession. But Claudia Sahm herself, I think has gone on record as saying that it's not clear that that's where we are. There's a lot of conflicting evidence in the economic and in the labor market data, and we're just going to have to watch very closely what happens the next couple of weeks and next couple of months.
So you're saying that we shouldn't look too closely at the SOM rule, but then, traders will definitely be motivated by the data that they're seeing. What is a better gauge of what the economy looks like? I mean, aside from the weaker, the upcoming U.S. economic data.
Yeah, I think we are going to have to look at the economic data. In particular, we're going to have to look for signs that consumers are retrenching. The issue now for us is a change not necessarily in the data, because directionally we're moving in the same direction. The momentum is in the same direction as it was even just a couple of weeks ago. The issue is that there's been sort of a potentially dramatic shift in sentiment. And we're going to have to look to whether businesses and consumers begin to retrench, begin to reposition themselves in the market in anticipation of a slowdown in jobs, in business activity and consumer activity. I think that's going to be the better indicator for us. And so the Fed and everyone else, I think, are going to really be watching. What does the consumer do next? What do businesses do next? that next set of labor market data is going to be critical. What this also does point to, however, is the possibility that the Fed, is again caught behind the curve. And by that, I mean that there was an opportunity to lower the Fed funds target in August. They did not exercise that option. Instead, they gave us, fairly reserved language around a rate cut being on the table for September. Looking at the options trading data, talking to folks here in New York and elsewhere over the last 24 hours, I think where we are today is not in a place where it's a question of, okay, there will be a rate cut in September, but an increasing likelihood that we'll see, a 50 basis point rate cut, that the Fed may not at this point feel compelled to intervene before that meeting. They're going to watch for signals or signs of contagion, of course, but absent significant contagion, they wait to September, and it's more likely now that we'll get a 50 basis point cut than a 25 basis point cut.
Right. So to clarify, you don't think there will be an intermeeting intervention by the Fed between now and September? And also for that September rate cut, when it goes ahead, we are likely to see a deeper one than what was originally priced in?
Yeah, I think so, on both counts. One, unless there is significant evidence of contagion, that the slowdown in the market, the decline in the indices having an impact on the banking sector, on the flow of credit, absent those things, it's unlikely that we'll see the Fed intervene, before the next meeting. They're of course going to be watching, for signals that they do need to step in, but right now it's not clear that they do, and so I don't anticipate that. Come September, I think it's more likely now that we'll get a 50 basis point cut. The positive here is that the Fed has a lot of room to maneuver. Given where the Fed funds target rate is today, they've got significant flexibility to bring that rate down, allowing them to begin with a strong signal of support to the market with a 50 basis point cut in September. Again, today, I think that's much more likely than it was even just a few days ago.
Right. I appreciate your time and your insights. Sam Chandan there, professor at NYU, Stern Finance Department Director, Stern Center for Real Estate Finance.